Thanks for tuning into Talking Point. I'm your host, Niraj Shah. We would have read newsletters, we would have heard him on con calls a number of times. He's arguably regarded as one of the finest minds when it comes to the fixed income market in India. And I'm talking about the CIO of Aditya Birla Sun Life Mutual Fund, Maneesh Dangi. But what I have today uh, on the show is Maneesh Dangi, the thinker, on a variety of topics and not just fixed income. And the couple of conversations that I've had with him in the past few weeks to try and assess as to what should we talk about leads me to believe that there'll be a lot of learning over the course of the next 30 minutes. Manish, so good having you. Thanks much for taking the time out and speaking to us.
Thank you, Niraj. Good morning to everyone.
Yeah, Manish, so let's start off with the big picture, right? I mean, uh, it's almost everybody knows that yes, the world will is not the same in post COVID, but somewhere people believe that a lot of things will come back to normalcy, maybe not in 2020, in 2021 maybe. Do you reckon that that's a fallacy and maybe we need to get used to a new normal?
It's fair to assume that most things will get back to normal, but many material things will change, Neeraj, dramatically, and it's far too big a crisis to for someone to presume that status quo would prevail, and it's sort of a once in a century crisis. I think dramatic changes in consumer habits, business habits, more importantly, would happen, and that would mean good and bad implications. For a variety of businesses, given that you and I and most of the audience is interested in how businesses would sort of behave. So I wouldn't reckon that material changes won't happen. There will be dramatic changes, and there will be big winners and losers because of COVID-19. Post-pandemic world would be very, very different.
Okay, and I'll come to what businesses could go through, Manish. But can we first talk about a broader macro and what would it mean for the world? What could it mean for India within that world as well? Then, of course, we'll dissect India within the equity side and the non-equity side as well.
Yeah, so let's sort of look at, firstly, from the point of view of who are the big winners and losers, okay, of COVID-19. And the obvious losers that we all know are because of the altered sort of consumer habits. I mean, my father, who would never not read a newspaper today, seems comfortable, reading news on WhatsApp and Bloomberg website, right? So in a sense, it's a substantial alteration of his habits, and he's fine, saving $5 every day and not buying a newspaper. So which is why the media habits would change. Entertainment actually would go through a major change in terms of landscape. Cinema going would perhaps not return to pre-COVID world for long time. Now, these are consumer habits, but I think more dramatic changes would take place in the business habits. Something like business travel would not return to normalcy for many years to come, because firms would find it such a big opportunity for all of them to save cost on business travel. Every time we travel business from one place to another, it's an enormous cost for the firm. So in a sense, that part of the business won't return, and therefore airline business would actually struggle, because business travel was a large part of the total sort of earnings that they were making. Similarly, for the firms, now the commercial real estate, the city center real estate actually doesn't make sense, because now sort of people can work from homes, work from small centers, and that is of course a saving for the consumer. But I think for the firm, it's a big saving, because it doesn't have to spend, let's say, large amount of money on per cubicle or per capita that it was spending, sitting in what do you call city centers. So I think city centers would be big losers because of the COVID crisis. Now, of course, there are many winners, in terms of businesses. We all know that, let's say, e-commerce or any delivery business is a very big winner. We also know that businesses like healthcare, because as a country, particularly India, we are far too underinvested in a business, or rather in healthcare, both personally as well as a nation. And I think a large increase in healthcare spending and wellness spending, I would say, would happen over the next couple of years. And I think that industry would be a very, very big winner. But I think for the world at large, and more importantly for India, the service industry could be as such a very big winner. There are massive productivity gains which can happen, which happens once in a century kinds. People don't appreciate this, Neeraj, as we were discussing, I think yesterday, that so much saving could happen if you actually locate your workers, nearer to their places, or possibly their homes themselves. I mean, as an average Mumbaiker, you and I know that we spend about 2 hours actually on roads every day, and we spend about 6-7 hours in office. So that's the whopping 25% saving of time, if we can sort of stay at home. So in a sense, service industry, particularly tech, but also BFSI, would be dramatically sort of benefiting because of the productivity gains of workers. So that's the post-pandemic world of winners and losers. Now, as you said, what about the country? And I actually, for one, believe that India would be big beneficiary of a post-pandemic world, not because of the changed consumer and industrial habits, which will sort of augment the performance of firms, but also because of the geopolitical reset that we are experiencing. I mean, Neeraj, you and I know that if you are in Seattle, or if you are working with Panasonic or Toshiba or Samsung, it's very unlikely that you would set up your new plant or the coming plant in China. And because there is this China versus rest of the world playing out in the post-pandemic world, people are looking at that country with huge amount of suspicion. Now, where would these companies go, or the firms go? Perhaps Indonesia and Bangladesh and many other countries that they've been going to. But India offers a unique opportunity for them because it, of course, has huge amount of consumer base. But also, I think now this government is actually working real hard to ensure that those firms come to India. So I think India, Neeraj, would benefit quite dramatically. Apart from, of course, the geopolitical reset, I think the capital cost would sort of remain super low for the rest of the decade. And also, Neeraj, the last point, of course, is that we have digitized the country far too. I mean, for last few years, quite substantially. And I think in the new world, we are ready to sort of embrace the opportunities that the world offers to us.
Okay, and I don't think it can be all rosy, Manish. I would want to pick your brains on, while the opportunity is present, what are the things that India needs to do, right? Because as much as we want to say that we have improved the ease of doing business rankings, and some of the things have certainly improved, even though we are naysayers, or large portion of people may be naysayers, it's probably more work that needs to be done. But just before we get there, can I talk about a few things? I heard you mention that a bit of macro, then we'll get to the micro again. I heard you mention that you believe that rates will stay lower for, did you say a decade? Now, if you did so, why do you say so? Because I would really want to understand from you, because you are one of the finest minds on the fixed income side, any which ways.
So, Neeraj, first of all, the shock is unprecedented, or at least once in a century kind. Massive unemployment pretty much across the world, not just in developed markets, but also emerging economies like India. So, in a sense, it's very, very unlikely that interest rates would actually go up. Now, remember that what Pavel said, just a few months ago, that it's a new world that we live in. This, first of all, if you see the dot plots by Fed, you realize that they are actually committing to near zero rates for 3 years until 2023, and despite the fact that the Fed members believe that the growth would return to normal since after 2021. Yet, you would sort of have interest rates stay depressed in US. Now, that's not just in US. You have Japan, Europe, Australia, pretty much across the developed world. Central bankers are coming forward to commit themselves to low rates for very long. Now, remember that after GFC, which was relatively milder crisis, the interest rates remained low, or rather zero, for 6 years in US. Now, in this case, I would imagine that interest rates could actually stay low for even longer. Now, of course, we in fixed income always worry about something called inflation, which is the biggest enemy of bond. Now, what happens to inflation if because of this coordinated fiscal and monetary response? Would inflation return? Right now, it appears to me that the inflation would remain subdued for a long, long time. But then here, you have an opportunity in fixed income from the point of view of central bankers committing to low rates, even though inflation returns. This is what the Jackson Hole comment of Powell was, that, let's look at inflation from a business cycle standpoint. So in a sense, while they target 2% inflation, and I'm talking about US here, even if it goes to 2 and more than 2, the Fed would actually look at inflation from the point of view of whole of business cycle, and intertemporal adjustments would be allowed. What it means, Niraj, is that if last few years, you've had low inflation or below 2% inflation, for few years, the inflation will be allowed to run red hot for next couple of years. Now, that is a very different paradigm that we are living in. As I was telling you yesterday, after a long time, the central bankers are actually completely reorienting their policy making. So basically, expected that inflation would stay low, and more importantly, if inflation once in a while sort of starts to reassert itself, that central bankers will be far more tolerant. So to summarize, we live in a world where, anyways, it appears to me that we would take very long to sort of return to normal. In case we return to normal, central bankers will tolerate low inflation, and thereby I conclude that in pretty much whole of the world, interest rates would sort of stay lower than what we saw in the previous decade.
It'll be foolhardy to second guess central bankers, Manish, but what's your sense of what could happen to the Indian central bank's thought process too? Because we're seeing some inklings of slight inflationary pressures, as temporary as they may be. What are your thoughts there?
No, so I mean, look, India has no macro or external binding constraints of cutting rates even incrementally. The chief reason why bond markets are somewhat skeptical in India is because the retail inflation sort of has risen quite substantially and stayed at in 6.5% range for last 6-7 months. Now, is that a sort of cause of worry? Of course, it's a cause of worry, but sort of one can assume that majority of these are actually because of the supply side disruptions that we've seen in the post-COVID world, or rather during the pandemic on the food supply side, and some of it will actually subside. But Niraj, I'm not really worried of food inflation because one, it is necessary that we had some food inflation for far too long. Our farm economy was in big distress, and in some sense, it's some kind of a stimulus that urban India or consumer India is providing to them. So I'm not too much worried, Niraj, of the food inflation, and I think central banker will be cognizant of this, that some of these inflation flare-ups that we've seen are transitory, fleeting, and would subside. So I'm quite confident that Indian rates would stay low for very, very long, if not for the whole of the decade, because we are an emerging market, and inflation is an easy thing to come by. But I think next couple of years, 2-3 years, we would see super low rates in India too.
Okay, and we'll talk about, I would want to pick Manish's brain on the art and science of forecasting too, but since we are on the topic of trying to forecast what could happen, Manish, a sense on the evolution of the external account in India, because I presume you believe that on the CAD front, we would actually be net positive 5 years down the line. Can you tell us a bit about that?
No, we're already positive right now, but that's
Yeah, I
because
mean
of the
incrementally.
demand. Yeah. We're actually this year, likely to see $25 billion of current account surplus. That's, I mean, for viewers to know that, this is like it only 4 or 5 times would have happened in last 70 years. Okay, so first of all, it's a big deal, but unfortunately, it's happening because of the complete demand destruction that we've seen, and of course, which is why imports have fallen a lot more than the exports. Okay. But then, there are emerging trends, which suggest that the current account paradigm in India could actually meaningfully change over next few years. For one, and everyone understands this, that in the new world that we're living in, the crude prices would actually now settle at somewhere between $40 to $60 or $30 to $60, let's say, over perhaps whole of the decade. Once in a while it could flare up, but it's very likely, given the emergence of now EVs, which have already come, and they are very efficient machines now, thanks to Elon and such people. Crude's prospects actually don't look too good, and which is why most commodities, while they've returned to pre-COVID levels, crude has actually stayed super low, and it's still 35-40% lower than year to date rather. So crude is a big saving for us, Niraj. If basically, if the crude stays at $40, then instead of spending 80-90 billion dollars that we were spending, we will be spending about 30-35 billion dollars less, in 22-23. So therefore, huge drop in crude itself, it means that the total rent that we are paying to the rest of the world, particularly the oil producing countries of Middle East, that goes down by near 1.5% or 2% as a percentage of GDP. So basically, now, if the crude's cost is substantially lower, and if our Atmanirbhar Bharat, the whole the edifice of manufacturing in India finally start to sort of manifest itself in areas where government is seriously working on. One was the Make in India idea, which was very general. But Neeraj, this Atmanirbhar Bharat is a far narrowed focus on stuff like pharma, what do you call, electronics, defense, and I am beginning to see successes there. I don't know whether people appreciate this, but in defense we've become an actually exporter. I think we exported about $2 billion worth of guns and such likes. So in a sense, we are among the top 30 exporters of defense. We are on electronic side. Our imports have actually peaked a couple of years ago, and we are beginning to export there as well. So if our exports, especially in these three areas, actually improve, and more importantly, if the import actually go down in these three big areas, electronics and defense particularly, I am seeing a new paradigm, Neeraj, in which we could, become a serial current account surplus country. So my bet is that over next 10 years, our current account would be on an average surplus. It has large implications, and we can discuss that. But that's a bit of a contra view that I'm taking, that we will not return to current account deficit economy on a sustainable basis over next decade.
No, I would want to discuss that, and I think it's a credible point that Manish you're trying to make, simply because maybe we can't control a crude per se, we can't somehow control the gold imports in any fashion whatsoever, despite measures. But electronics and conversations with Dixon, for example, suggest that there's a large order flow in there. Or defense, I think there's a company, the Mazgaon Shipbuilders IPO, and the management was saying that they are actually talking about even doing export orders. So yeah, it's completely credible. But could you elaborate a bit on, I mean, because a lot of people would want to understand what's the impact of this leaf turning around the corner in a sustainable basis? What's the impact?
Yeah, so on Neeraj, on a, let's say, $3 trillion economy today, if we were to be status quoist, we would have actually net bought stuff worth $60 billion, right? Which is called current account deficit. I mean, we import large amount, we also export. The difference of that is current account deficit. Adjusting for all the services and the intangibles that that's also a bit of an export from us. both human capital and our IT services. So basically, in a counterfactual world, had things remained as they were, meaning at $80, $75 crude, and economy chugging along as it was, in pre-pandemic world, we would have been about $60 billion of current account deficit. Now, because of the demand destruction and a sharp price drop in oil, we are going to be at $25 billion current account surplus. Okay, so that's a huge $85 billion shift. Now I'm making an argument that this crude, would stay here for long. So in a sense, that saving is sort of somewhat durable. Okay, and there are fundamental reasons. I'm not talking speculative on crude. There are
Sure.
fundamental reasons that the crude would continue to stay depressed. Here, I'm only speculating that the Atmanirbhar Bharat idea on electronics and defense, would actually gain ground, and that means our export actually would start to sort of build up. Now, what implications do they have? So instead of a $60 billion of current account deficit in a post-pandemic, no demand destruction world, we could be actually near zero current account. And if that happens, then what happens to all the FDI, all the FII money coming in here? That becomes our large balance of payment surplus. So I mean, I expect that, and remember, I talked about the geopolitical reset in the beginning. That a lot of firms will actually begin to relocate to India, especially in the areas that we have discussed. That means, I would imagine that between FDI and FII over next 4 to 5 years, an annual, 80, 90 or $100 billion of money would actually come in. To top it up, of course, the banking capital and other sources of dollar flows would continue to trickle in the country. All of that actually becomes a surplus for the country. That will eventually one day become a headache for RBI, because it will continue to suck dollars because it can't allow currency to appreciate meaningfully, lest we lose our competitiveness. So which is why it would continue to suck those dollars, and I imagine that our reserves would be crossing $1 trillion in less than 5 years' time. All of this money would actually ease financial conditions in India quite substantially, and so a lot of stress that we see on what you call lending side, would begin to ease, and our sort of spreads would begin to ease up everywhere. It would also mean that the risk premia that you charge for both Indian bonds and equities would actually drop, in that kind of world. So there are far too many implications, but these are the top 2 3 ones that I can share with you right now.
But that's not great for savers, isn't it, Manish? Because you effectively saying that everybody who lives on that post-retirement income through fixed income uh, cannot survive on that anymore, or will not be able to survive on that a couple of years down the line.
I agree, Neeraj. I've had this ideological sort of conflict with the ideas proposed by our governors. Both Patel as well as Rajan. In a developing country, to induce such high real rates that we were trying to flirt with. Remember Rajan's days, where every conversation the journalist will, such as you, would ask him as to what is a real rate, and then he would say 1%, 2%, and so on and so forth. We were coming from an old paradigm of actually giving no real rate to the saver. Suddenly, we exposed this economy, which, by the way, was completely ruined by high indebtedness of the corporate India. We induced high real rate, and which actually sort of devastated our what do you call it, corporate India, I would imagine. So unfortunately, it's not a good news. This 4 5 years of a great period that savers had, where they realized a very high real rate, almost unprecedented in India. In India's history in last post independence, you wouldn't have had this kind of high real rate. You understand the meaning of real rate for the audience is that what do you call it? What you get in a fixed deposit or fixed income, and minus the inflation that you experience. That's real rate. Now, in last 30 40 years, if had you put what do you call money in a good friendly neighborhood bank for 1 year and rolled it for 30 40 years, the real rate would have been absolutely zero. But in last 3 4 years, 5 years rather, since 2015 16, the real rate was very high. we are going back to the old regime, Neeraj, and bad news for my father, a retired man, and bad news for many other savers. But then, hey, this country has to build itself. We are at $2,000 per capita. We ought to build capacities. We have to induce risk taking. And for that, one instrument that's available right now with all of us is to actually induce low real rate. This is precisely what US is trying to do when it is saying that even though there may be a 2%, 2.5% inflation, I'll keep interest rates at zero. What are they trying to do? They're inducing risk taking. And this is a good news for corporate India, and this is a good news for economy in general. And finally, therefore, it's a good news for everyone. But you're right that if you're looking at a very, very narrowed view of a saver, is he going to get a lot of return in putting money in fixed deposits and fixed income in real terms? The answer to that is no.
Therefore, look at equities. But what happens then, just very quickly, Manish, what happens to a space that you champion? How does a borrower make money through the fixed income mutual fund route? Just a very narrow question, but trying to figure that out.
See, one is we all sort of preach what do you call asset allocation. So even though you could be super bullish on equities and real estate, you should still have some part of your allocation, some or large part of my father, let's say, is nearing 70, and he ought to be, let's say, 80%, 75% in what do you call fixed income now. In fixed income, unfortunately, is not going to give very good returns over the next 3, 4, 5 years. But this is the world that he lived in most of his life anyways. Most of the times he was putting in fixed deposits of the bank that he worked in. I tell him this again and again, you never got good returns. So it's not don't complain too much about it. But yes, from a fixed income point of view, Neeraj, I think the short-term funds and the low duration funds, would actually do a reasonable trick for you in actually securing, safeguarding your investments and ensuring that you do not lose materially in real terms, and the price of money actually sort of keeps track of inflation, especially in these funds. I think they should be able to do it. Remember, fixed deposits would actually do a much inferior job, because banks are right now struggling with a huge amount of NPAs, and their earnings are depressed, and which is why they have large amount of money available to them from RBI. They're sitting on 6-7 lakh crores of excess cash, on an average over the last 2-3 months. There is no incentive for them to borrow money at 5% or 6% also. So my bet is that most bankers will actually take fixed deposit rates even lower from here. And to that extent, relatively fixed income funds would do a better job. But unfortunately, the last 1 year, 3 year, 5 year returns, you've experienced great returns in fixed income. That won't recur. At least nominally, those returns would not be recurring.
And maybe that's why a lot of people say, viewers, that there is no alternative to maybe equities, at least for the near term. Sure, gold has done fabulously well, and asset allocation is always advisable. Or maybe equities kind of top draw. Manish, therefore, then and I'll just end this conversation with you for the last couple of questions. By taking the conversation back to where we started, within that investing landscape, the permanent disruptions and the temporary disruptions. What are your view there? We've seen Europe. I think you sent me that message, if I'm not wrong, about the kind of disruptive moves and that the European banks went through, right? If you look at the last 12 years, they've never gone back to glory days. In India, the common discourse is that financials still rule because we are a developing country. People still need money to set up projects, and therefore financials will still be front and center. Would that be a good argument, or would you believe that it's very important to pick and choose, even if financials would be front and center?
No, and so my point, Neeraj, is that this finance in India is going to grow manyfold. The total amount of debt and the number of banks and bank customers are far too low today relative to even our emerging Asia and other emerging market peers. So I have no doubt about it that finance is going to grow many fold. My point is that in the developed world, they're going to see massive problems, largely because of negative interest rates. How do you make money if interest rates are negative? In a sense, imagine the plight of a European bank. It takes a deposit of a customer, and let's say puts money in a treasury bill of 10 year or 20 years and earn negative returns. How do you compensate that bank, and what is the value of that franchise? Many of us have grown up learning that the banking is about the liability franchise. What's the value of the liability franchise in the case of a typical European bank or a Japanese bank or now an Australian bank? So in a sense, okay, that narrative for the rest of the world is different. That's not a problem in India. It's also not a problem. India's debt is not very high, and perhaps if a reasonable amount of risk taking is induced by policymakers, unfortunately they are dithering. But if they do, then I think finance would grow. The point in India, though, Albert, is that it will get disrupted. In a sense, the traditional way of banking, is not going to be the way forward. And I keep sharing this view with many policymakers that I personally know, that don't think of banking or financing in India by setting out targets for the banks, that okay, how many branches would you open? It frankly doesn't matter now. Your
Branch
iPad or
banking is dead.
Samsung pad is actually the branch for you. Niraj, can you believe this? That all of us in asset management firm, my firm, haven't gone to office for so long, and business is fine. We're perhaps working 3-4 hours extra every day. So whole BFSI piece, because in the post-COVID world, would look very different, and therefore my view is that it will get disrupted by the ones who adapt to the new regime. There is a large savings to be made, Niraj, and we can discuss about them if you wish, by actually relocating your people and to smaller cities, and of course having them work from home. But finances, operating costs will actually go down dramatically, which will mean the ones who adapt to this would benefit dramatically, and the ones who don't actually will decay eventually.
Interesting. So it will become very company specific and policy specific. Companies which are able to do that and have
Yes.
the management willingness to do that might actually benefit disproportionately. Okay, we are almost out of time, but last couple of things, because I can't not talk about it, because at the start of this conversation, Manish, you presented a very interesting point about uh, things which get disrupted positively and negatively. I just want to understand with you, from you, as a final thing, what do you think is permanently disrupted and why?
As I said, business travel. Let's say, Neeraj, your firm, if you actually travel to Delhi, 6 months later by business to, let's say, meet someone in North Block and to interview him, your firm would say that, why did you spend, let's say, to and fro business class travel, living in a 5-star hotel and having a sumptuous meal? Why did you spend all of it, if you could do it on Zoom? And so, in a sense, in companies are super smart animals. As I said, in the consumer habits would still take time to change. But companies have found this as a gold mine. They would restrict so many expenses which were considered to be sort of routine ones, and business travel is one such big expense. So I think they'll be disrupted meaningfully, and won't return to the to the pre-COVID world for long time. Something similar you could say for the commercial real estate also. The very place that Neeraj, you're sitting in, which is Lower Parel, let's say, in Bombay, it's been 6 years, 7 years. Prices have not gone where they were in 2012. Perhaps for a decade it won't go back there where it was in 2010 or 12, because this is far too expensive a place. You could do the same business sitting in Noida. If all of it, you have to talk to me on Zoom only, or the whatever platform that you're using, then why do you have to be in what you call Lower Parel, paying 4 lakh rupee or 5 lakh rupees per cubicle? So in a sense, even that part would get disrupted meaningfully. But for a consumer, there are large implications, Neeraj, and I don't think, you and your audience, would be much interested. But it's for the government, the medicine world is going to change dramatically. Because of the telemedicine, India has this unique opportunity to ensure that a doctor reaches like Modi ji talks about water. A doctor reaches every household on WhatsApp video call. So telemedicine is going to disrupt the healthcare completely. Similarly, education. My boy actually, 11-year old boy says that, Papa, the way for schooling now should be that 3 days work from or school from home, and only 1 or 2 days going to school, so that we can sort of chit chat with our friends and meet teachers. So the education, or rather tele-education, would be massively disrupted. So in a sense, lot of changes, Neeraj, which we will see. Only one last line, Neeraj. People, would believe that why all of this suddenly. Telemedicine could happen earlier. YouTube videos on or Coursera videos were always there. It's just that when a crisis happens, Neeraj, suddenly you are forced to change your habits, which otherwise would take decades, happens in weeks. And this is what has precisely happened, and which is why the new world would be materially different. Don't scoff at people who say that it'll be different, because it'll be truly different.
I know. Well, forced acceleration at times gets people to try and maybe study about these changes and learn how to deal with them, because it's upon you and you don't have a choice but to deal with it. But it's a pertinent point. Manish, it was a pleasure talking to you today. Thank you so much for taking the time out and speaking with us on Talking Point. Really appreciate your time.
Thank you, Neeraj.
The pleasure is ours. And viewers, thanks for tuning in to this edition of the Talking Point.